Hello class, in this video I'd like to show you how to prepare a statement of cash flows. Now this is also called a cash flow statement, and I'll be using that term as well. Now the cash flow statement shows us where the cash came from and where it went for the entire year. We use parts of the income statement and parts of the balance sheet to show us where all the cash went and where it came from, so we can tie together the beginning and ending cash balance. So let's get started and remove the picture here. Alright. On the right side of the screen you can see I have prepared an income statement and also a balance sheet. The balance sheet is for 2 years because we need to find the changes in all the accounts. On the left side I have the setup for the cash flow statement, and I have everything typed in just to save time in this video. The first place you start is with net income. So we go straight to the income statement, pick up the bottom line net income figure, and we'll type in the income of $8,200. Next, we need to find depreciation expense. Go straight to the income statement under operating expenses. Here's depreciation. Type it in, and we always add back depreciation expense. Now, if net income would have been a net loss, we would have, of course, a negative figure here. But we have net income, so we have a positive $8,200. Depreciation expense is $4,000, and we always add depreciation expense. After depreciation, we look for gain or a loss on sale of other assets. You can see here we have a gain on sale of land. This could have been, for example, loss on sale of equipment, loss on sale of building, or gains on either one of those two. So we have in the income statement under non-operating items a gain on sale of land, $1,000. And when we have a gain, we subtract a gain. Okay, that's the way it works out. It's difficult to explain in such a short video everything behind these numbers, but you always subtract the gains and you would add the losses on these gains on sale of these other usually long-term assets. The next step is to go through all of your non-cash current assets. All of your non-cash current assets. And for brevity, I only have two: accounts receivable, inventory. And look over here, and this is the 2000X1 year, 2000X2, and so receivables went up $900. And since that means we did not collect that cash, we subtract the increase in receivables. So that's the rule for the change in current assets. If the asset went up from last year to this year, then we subtract the increase. If it decreased, we add it. That's what happened with inventory. You can see inventory went down $500 from the previous year, and we add $500. After you go through all of your current assets, and you can have more, such as prepaid rent, prepaid insurance, those type of things. After that, you go through all of your current liabilities. Now, in your current liabilities, the rule is different. So, for example, accounts payable went down $10, and so we do subtract, whoops, let me get this here, subtract $10. Okay, so in other words, how do you get your accounts payable to decrease? You have to use cash to pay those down. So you subtract a decrease in a current liability. Interest payable, another current liability, went up $5, so we add $5 here. And with what I have as the example here, we have the net cash flow from operating activities. So we've gone through and put down net income, add depreciation, we subtract a gain on sale of land, or you subtract or you add a loss on sale of land, building, or equipment. We've gone through all the non-cash current assets and all the current liabilities to account for those changes. So we're finished with the first section, and this is the net cash flow from operating activities. Next, we look for investments or sales of long-term assets. So I have here in other information that we constructed or purchased a building, $12,000. That's also the change in the building account. We did not have a building, now we have one. So since we used cash to purchase the building, it's a negative $12,000. We sold the land. Yes, we did sell at a gain, but we received more cash than the $1,000. I have here that land costing $5,000 was sold for $6,000. So we received $6,000 cash for this. So that's a positive $6,000. And what we've done now is we found the net cash flow from investing activities total. So it's a negative $6,000. The next section is cash flow from financing activities. This will be where we are collecting cash from selling stock, borrowing long-term debt, we're receiving cash, and several other sources, and also cash going out the door, for example, paying dividends. So look over in the balance sheet. We sold some additional common stock, $5,000. That's cash that came in the door, so positive $5,000. And then we paid dividends during the year, $3,000. That's cash going out, so negative $3,000. Okay. So now we've computed the net cash flow from financing activities. That's $2,000 positive. What you will do, and of course I already have this set up to save time, you now net these three main sections. Net cash flow from operating activities, it's a positive number. We have a negative cash flow from investing and a positive from financing. Net those out, we have a change in cash of $6,795. What we'll do next then is take our beginning cash balance. So at the end of 2000 X1, that's the beginning balance of X2. So we pick up the $1,000, add it, and what we have next is the ending cash balance. So this $7,795 must equal the $7,795 we have in the ending balance sheet. That must equal. Once we've done this, gone through all these sections, accounted for all these changes and the cash flow involved, we have proven that the overall net change in cash, $6,795, ties into our change in the balance sheet account of cash. It went from $1,000 up to $7,795. Now, we are through with the cash portion of this statement, but you do look for other major non-cash transactions. The one we have here is that we did purchase some equipment by signing a note payable. In other words, we did not pay any money down, so no cash was involved, $2,000. It does not go in the upper part of the cash flow statement because it does not involve cash. We drop the $2,000 in here, and we show that, did I type that right? I guess I need a little bit more. There we go. I have the pennies in here, that's why it gave me the X's. But anyway, we have a completed statement at this point. This is a finished cash flow statement. Again, it shows where the cash came from your operations, what you're in business to do, in other words. You've made the sales, you've paid expenses, so here's the cash generated, and you would like to have this as a positive number. In fact, you need to sooner or later for many years, or you're going to run out of cash. What did you do with your cash? We purchased a building. We sold some land to acquire some more cash. So these are your long-term type assets, buying and selling. And then your financing activities, did you borrow a lot of money on like long-term debt? Did you sell more stock? Did you pay dividends? It goes in this section. So this is the cash flow statement. So good luck with your studies.